I see some green shoots.
We need to have some kind of stupid bar.
I just think this is a classic structure, Lamont.
And I'll show you guys, a little trick here.
When you see some of the stuff.
Welcome back, Wyckoff Nation, to the Wyckoff market discussion. What a special occasion we have today. 500th weekly episode together with Bruce for all of this time, commenting and observing the markets, making some kind of wild predictions that some come true, some don't come true, but staying together and with our community, solving this puzzle that we call the market. Bruce, welcome back to the 500th episode. How are you feeling today?
Come on. I've been very excited about this moment. I'm thrilled to be here. This is going to be fun.
This is not just our achievement. We want to acknowledge the team behind 10 years of work, and multiple people were providing support to both of us and to this program and to the community to stay connected each week for this 500 episodes. So thank you to the team, and obviously thank you guys so much. Some of you have been with us for 10 years. I can't imagine what a soap opera it was, and I mean, obviously the markets, we're just neutral to the market. We're just observers. But it's been such a fun road, Bruce, and I just want to personally thank you for being my partner for all of this 10 years in such a great class. It doesn't even feel like a class. It's more like, WMD, let's have fun, that type of feeling. That's what I have usually. And then just learning from you, from your experience, from all of the years that you've accumulated as an experience. It's just amazing. I know that the whole community is also extremely lucky, so lucky to have you on board for 500 episodes. And I just feel like that's a huge achievement, for us and for me personally, like to be so close to your thoughts about the market for so long. So I appreciate that.
Well, I want a big thank you to our community who have been here for a very long time. They're very supportive. It's just so much fun. I so look forward to Wednesday afternoons. And so thank you all. And I love working with our team, which is just phenomenal. And you guys all keep me sharp. And we have two special guests who are very, very important to us all. And so, full speed ahead. We're going to have a great day here.
All right. And with that, let's move on. We definitely have our Wyckoff Analytics team standing by. Joe Turner is here. Joe has become a part of our team, which I'm so thrilled. And he was a partner of Martin Pring and Bruce Fraser in Pring Turner Capital, and I'm sure they will mention this. Until Weber, our already the third semester, a co-instructor of WTC2, coach in our training, and just amazing expert on chart reading. We're going to talk a lot about the markets with him. Alessio has been our contributor for years and years. He is probably one of the first team members that we had on the contributor side after Bruce. So can't wait to talk crypto and Bitcoin with him and the markets in general. Obviously, Bruce for all of these years, and a special guest, Martin Pring. And from here on into this new segment, Bruce, you take it away. Martin and Joe have been partners and friends. You've been talking markets for years and years. I cannot wait to listen to your discussion.
Well, thank you, Roman. And really, just to introduce our two very special guests, Martin was introduced to me as a student in graduate school by Hank Pruden, because Hank used Martin's Technical Analysis Explained first edition as his textbook. And I was so in love with technical analysis. The minute that I saw it, I just fell in love with this book, and I just carried it around in my grubby little hands endlessly everywhere I went all the time. I always had my nose in it, and because of that, Martin became somewhat of a god to me, and I was very starstruck the day that I was able to actually meet him. I never thought that possibility could have ever occurred. He was the ultimate rock star in my world. And so Martin and Joe introduced me to Martin, and then ultimately they became my business partners. And Joe and Martin are truly my mentors in this business, in this industry, in technical market analysis and business cycle analysis. And so to have them both here today for this 500th episode is special beyond words for me. And so, Martin, thank you for being here.
Well, thanks for inviting me, Bruce, and congratulations on the 500, you guys.
Well, thank you so much. And Joe is sitting here right next to me. And so, Joe, thanks for being here.
Well, want to wish you all a happy birthday, and Roman, a special congrats to you for putting up with Bruce for 10 years. I think that is what the real celebration should be about here. And I'm ready to drink to that.
So true.
Anyway, thank you. Thank you both. And of course, a big thank you to Roman, who came up with the idea of us doing these over 500 episodes or over 10 years ago, and pitched the idea to me. And I was just like, huh? I couldn't believe that we would even consider doing this. Here we are 500 episodes later. But the cool part is today is that we get some insight from Martin and Joe. And at the end of Martin's presentation, he has generously made a very special offer to us and given us a very special gift. So we have this wonderful gift for all of you for attending. And at the end of Martin's presentation, we'll show you how you're going to be able to put your hands on that. Anyway, so let's get started. So Martin, I recall a day in the mid 80s when we were having a phone call. We were having our weekly strategy meeting, and you showed us this concept of the 6 business cycle stages. And this was one of those iconic moments for me where I'm like, it was just so elegant in its ability to express this essential key concept of investing and bringing it all together. And I was just so dazzled by it. And I just thought, I wanted to just put it up here, and I'd love for you to be able to tell us about the inspiration that brought this to us, because I see it everywhere. I see it all over the place. I mean, people use this in the industry constantly as a roadmap for how to navigate the business cycle. And it's Martin Pring is the one that brought this into the world for us to use as a tool. How did you get here, Martin?
Well, I found somebody else had designed it ahead of myself. I was at work one day. I picked up a book called Turning Point in Business Cycles by I've forgotten the guy's name now, Colonel Ayers, who actually also invented the advanced decline line. And he was showing that there was a definite sequence in the economy between stock issues, stock prices, bonds, commodities, and so forth. There was a definite rhythm, and this was in the 19th century. So I just took it a stage further from his knowledge. And the idea here is that the business cycle is nothing more or less than a set series of chronological sequences. In a very simplistic way, it starts off with interest rates falling as we enter a recession. When rates fall, people decide, well, maybe I can afford a house now, so they buy houses. And those houses, of course, have to be filled. So another economic indicator in manufacturing turn up. And then eventually the manufacturers get so many orders, they got to build a new plant and equipment. So that's another stage in the cycle. But the good thing, and it just keeps repeating it, and I make it very, very simplistic here, but there are literally hundreds of these events. But there's also another aspect to it, and that is the turning points, primary trend turning points, for stocks, bonds, and commodities. There's three markets. Each one has two turning points, and it's easy to work out. You're going to have 6 stages to the cycle, 3 times 2. And the cycle goes through its chronological sequence, rather like the calendar year goes through seasons. So there's a certain time when you want to be sowing seeds, and there's a certain time when you want to be nurturing them, and a certain time when you want to be harvesting them. It's the same thing with the financial markets. We start off with stage 1 going into the recession. The economy is very weak because it's in recession, of course, and people start to buy bonds. Then as the interest rates continue to fall, people in the stock market begin to anticipate the next recovery. And that anticipation begins when the news is blackest, because when it's blackest, it obviously can't get any worse, and that's a great time to be buying stocks. So the stocks bottom out, and then the economy recovers some more, the demand side on the equation for commodities starts to pick up. So commodity prices pick up. Then as we move through the recovery, the expansion causes people to want more to borrow more credit. So the demand for credit goes up. So the price of credit, which is interest rates, also goes up. When interest rates go up, bond prices come down. And at the top of the cycle, the stock market, this is the point usually when you have maximum growth, people decide in the stock market, well, we're going to sell in anticipation, usually of the next recession, but more commonly in the last 2 or 3 decades, it's been in anticipation of the next growth slowdown. Growth slowdown being when the rate of growth comes down, bottoms out, but it bottoms out above 0, not like in this diagram here where it bottoms out in the stage 2. So there's our 6 stages, and you notice that we've got stage 4 has been colored in blue. The reason for that is that right now we're in stage 2. Stage 4. And how do we know that? Well, we have models for each of these. We call them barometers for each of these markets. When all the markets are bullish, that will put us in stage 3. When bonds start to go bearish, commodities are bullish, and the stock market is bullish, that's when we get to stage 4. And that's where we are right now, according to our models. So could we maybe move to the next slide, please?
So so when the news is the worst in the economy, when things are the bleakest in the economy, is actually the point when you should be considering buying stocks. And when the news is the very best at the top of the business cycle is when the markets start to discount worse times coming, and it's a good time to be selling stocks. So it's very at the extremes, it's very contrary.
Yeah, that's also the time of the maximum growth rate when you should be selling stocks. So this is what we did was we went back to the 1950s with all this stuff, and these are the results that we came up. So on the left-hand part of the chart, you can see stage 4, which is a time when you should be buying commodities. The star performer for all the stage 4s since 1955 up to 2011 was copper, which made an monthly annualized gains of 24%. Crude did 16%, platinum 15%, gold 14%, and so forth. And then the Bloomberg Commodity ETN, the DJP, achieved 11%. Obviously, the ETF wasn't around, or the ETN wasn't around in those days, early days. So we tacked on we spliced it to the actual indicator. When it comes to the stock market, what you would expect to see is that the commodity sensitive sectors or industry groups tend to do quite well, and that's what you see from the table on the right there. So something like oil and gas, 17%, three up from the bottom there, made 17%. Metals 18% on the bottom, and surprisingly, utilities making 14%, which you wouldn't really expect, but that's done over a number of cycles, over 50 years or so. So when you're looking at the three markets themselves, you find that the star performer in stage 4 is the CRB spot raw industrials, 13%. Stocks made 9%, and bonds made -8%. So that was the thing to avoid. Would be bonds. Now, if we look at the next slide, what we have here is a kind of the gray line there, the bell curve there, is an idealized long-term smooth momentum indicator. It could be a stochastic, an MACD, but of course I use the KST, which is my own indicator, because I think it's slightly better than the others, but that's maybe a little bit of a personal bias. So what we're looking at here is, if you're interested in buying something, the best buying place is in spring, in that green area, where as the momentum is starting to come up. And then we get into summer, that's when we get into the markup phase, and then over on the left-hand side, when it starts to fall or decline, that is the fall quadrant, and then we go in finally into winter. So if we're in stage 4, what we would expect to see, let me back up a second and tell you about these red and green arrows. The red arrows indicate industry groups or sectors that have a tendency to outperform the market in the early stages of the cycle, whereas the green arrows represent industry groups and sectors which tend to do better at the tail end of the cycle. In other words, on the left hand, on the red, we're the liquidity driven, and then the green tends to be earnings driven. So we're in stage 4. What we'd expect to see is the predominance of green arrows on the right in summer, and a predominance of the red arrows for early cycle stuff, leading the market down or helping it to top out on the left. And that's exactly what we see here. Not everything works out according to plan, because you've got on the fall side, you've got one green arrow there in industrials, which really tend to do better at the tail end of the cycle rather than the beginning of the cycle. That's there. I'm just putting it out to show you that this is not a perfect situation. Not all industry groups behave as they should do at certain stages of the cycle. But so we have to take a collection of them, and when we take a collection, you can see the predominance of green is lagging, which would be consistent with stage 4. And then the on the left-hand side, the curve is coming down, and that's consistent with most of the early leading groups, including the first one down on the left, which is the S&P, which has just slightly started to turn down last month. So that's not a signal to sell the S&P, but it is a signal to tell you, be prepared for maybe some kind of a distribution forming. Just a little hint.
Fascinating. So really what the 6 stages and what the business cycle does is it gives us a roadmap. It's a way to be a dynamic asset allocator. So right now in stage 4, the bond market would typically not do well in stage 4, being down 8% in the on an annualized basis on average over that period. It's just like, this is remarkably valuable for an investor, is to be able to anticipate this.
Yeah, and the other thing, the chart, that if we could go forward one slide, please, Roman. The chart also tells you what you should be buying. And if there's a lot of stuff in spring, that's what you should. That's one of the ingredients to say I think I should be buying that particular sector or industry group. Well, there's nothing in spring, but there's lots of stuff in the markup stage in summer. So that's another thing to say. There are not a lot of bargains around because everything's so overextended. And
wouldn't that be classic stage 4 behavior?
Coming down. Sorry, Bruce.
Oh, I was just gonna say, isn't that sort of classic stage 4 behavior?
Yeah, absolutely. So we got the industry groups individually confirming what the models are saying.
Yeah, yeah. So it's confirmation. Joe, thoughts?
We have a saying about trust but verify. So you'll trust that you're in stage 4 by the models, and then when you verify, when you actually look at the performance of gold and telecom and metals and oil and gas, now you've verified what your projection is, and here you've put it all together. So I think the models and the research that's gone on into these things is quite a gift to us as investors.
Yeah, and you can see that the bonds are in the worst possible stage in early winter. They just started to turn down. Whereas the industrial commodities are just in the early stage of the markup, which again is consistent with stage 4. What's not consistent is the S&P rolling over. Although this is remember, this is momentum, it's not trend, and the S&P is still above its 12-month moving average. Maybe we can move to the next slide, please. So here's my world bond index, which I feature all these things you're seeing here are featured every month in the Intermarket review. We follow very closely the business cycle stuff and that figure that you saw. I should have pointed out that in February there was a predominance of industry groups on the right-hand side. Now the predominance is on the left-hand side of that previous chart that we just looked at, the previous diagram. So anyway, here's the World Bond Index, which consists of US, German, and Japanese government bonds expressed in local currencies, weighted by GDP. And there's a couple of things here. First of all, you can see that the KST in the bottom window, or lower window, has started to turn down. You can see why, because last month, the World Bond Index made a decisive new low. And I expect to see US bonds do the same thing, because the 30-year yield is currently bumping up against resistance, and it wouldn't take much to push it through. And when you're in a period of rising commodities, you're in stage 4, it's a pretty safe bet you're going to see higher bond yields and lower bond prices. Next, please.
Martin, can I just ask a question about this chart before we move on? You know, since 1990, which is the history of this chart, you have this remarkable bullish uptrend in the price of bonds in the world, to the point of the top that we have, the head on your head and shoulders structure there. And now all of a sudden, not only has it broken that stride of that bullish trend, but it's acting so weak. What that would be a secular phenomenon, something that's multiple business cycle. What's your take on this?
Well, when you get contra secular moves, primary moves, they tend to be subpar. In other words, when you're in a rising trend, the short term, the primary trend buy signals give you the magnitude and the duration. When you're in a secular bear, it's the downside, the bear markets that give you the magnitude and the duration. And that's a very astute point it's made there, Bruce, because there hardly been any rally whatsoever after the first decline. It was just been a sideways consolidation, now a breakdown. So that again is confirming that the secular peak in yields was made in 2020, 2021, 2020, I guess.
So this could have profound implications for the sort of the dominant asset classes you want to focus on going forward, because bonds have been so popular for so long. All of a sudden, in a very dramatic way, they're acting kind of terrible.
Yeah, I mean, we don't know how long it's going to last, but all I can say is that the trend obviously is down. We're below the moving average. We've made a new low below the trading range. The KST has turned over. Commodity prices are making new highs on a global basis. So QED kind of thing.
Gotcha.
Okay, if we can have the next slide, please. Okay, I mentioned we determined the stages of the three models, one for stocks, bonds, and commodities. This is our commodity model. It consists of 4 different indicators, and when you get 50%, half of them are bullish. That's when we get one of these green shading or highlights on the chart. As you can see, it's captured most of the. It's not perfect by any means, but it's captured most of the large moves that have taken place. It went bullish back in 23, 24, and it's still moving up as we speak. And it's based on the CRB spot. That indicator you see is the CRB spot raw industrials. I use that because it's economically sensitive. It doesn't include any agricultural products. And the one thing it does, it's auto-included, doesn't, is oil. But it's worked very well over the years in terms of forecasting trends in bond yields and so forth. So that's why I like it. It's very economically sensitive. Right now, it's actually last month it went down to 87% from 100%, where it's been for a few months. And the reason was not so much because there's something bad going on in the commodity markets, because we use the 9-month moving average of the S&P composite more as a placeholder to say that when it crosses below its 9-month moving average, which is below, not its 12, but it's below its 9, that takes points off the barometer because that tells us we've reached a certain stage in the cycle. Just as if we're looking at the sunset and the sun is about just slightly above the horizon, you know that that's a placeholder to tell you that we're soon going to go into a darkness or a dusk darkness situation. It's the same thing with this indicator on the commodities. The S&P falling below its 9-month moving average. As long as that lasts, is a warning that the stock market is not as positive about the outlook for the economy as it was before. So on our next slide, see another chronological sequence. Remember, we have the 6 stages for the business cycle, but we're in a commodity stage, and there is actually a chronological sequence amongst commodities. It starts off with gold, then it moves to copper, and then it moves to crude. If you look at gold, the principal mover of the price of gold is not demand for jewelry and demand and supply for jewelry. It's actually investment demand, because investment demand looks ahead at whether we're going to an inflationary time or a disinflation or even deflationary time. So gold tends to move ahead. And what it's really discounting is higher or lower commodity prices. And you can see that with the arrows translating to the right, that the lows in the gold momentum usually, but not invariably, lead the lows in the copper momentum. Sometimes the two curves don't agree, like 2013 and 2014, for example. It was kind of very iffy. I was actually referring to the point before that arrow. That's it. You got it.
Yeah. Yeah.
So we've got gold, and then we have copper, and then if you look to the right of the lows in gold with these arrows, you can see that they slant to the right. Sometimes it's a long lead time, sometimes it's a short lead time, like it was in 2009. But the latest one has been quite long because the slant is very. Copper bottomed in 2014 in terms of momentum, and then only recently has oil turned. And I looked at this chart and I said to myself, well, that's interesting. There's definitely a relationship between copper and crude, but what is that? Why is that? And so I did what I do a lot of times when I'm stumped. I go to Copilot or Claude or Perplexity or one of these AR bots, and I asked them the question: why did copper lead oil in a typical cycle? And he came back with the answer that the demand for copper is determined by the restocking cycle, which is pretty sensitive to, whereas crude oil is more sensitive to things that expand towards the end of the cycle, things like transportation and so forth. I thought I couldn't come up with a better explanation. I'm not sure that is actually it, but it's definitely a relationship between copper turning and crude turning. So that's one of the reasons we were looking for crude prices to start to turn up, actually ahead of when they actually did, but they suddenly caught up with gusto in the last month for obvious reasons. So we look at the next slide.
So Martin, can I just make,
Yeah, sorry.
kind of make a point, but as a question is, this crude oil, which is just starting to turn up above this long-term moving average on the momentum, is just getting started, and you've got gold and copper already well on their way. So does this mean that this move up in crude oil could be more persistent and for longer than people are anticipating?
Yeah, good point. I'd forgotten about it. Look at gold. I mean, look how that's gone up to 891.
That's a stunning advance.
Yeah, it's got to mean something if it's discounting inflation. So other things being equal, it suggests to me that we're going to get an above average commodity rally, just based on that one indicator, on that one observation. We don't know for sure because we don't have enough history on it to see gold move up to those levels. The other thing is, just because oil is just turned doesn't mean to say we're going to get a huge rally, because it can sometimes fool us, like it did in 2013 and 2014. Yeah, the crude oil momentum just barely turned up and then it turned down again. Same thing with copper. But generally speaking, what I like to do is to follow the trend and not try and get too smart about trying to see about magnitude, unless I'm seeing a huge pattern developing in a particular commodity or the index or what have you. And that's what we have in the next slide, I do believe. Yeah, here's the CRB composite in the oh no, it's not, sorry. I'm getting ahead of myself. Okay, this chart here is designed to kind of indicate when we get one of these inflection points between, in this case, between gold and the CRB. So we know that the momentum in gold peaks ahead of the momentum in the CRB, and we're trying to find a way of tracking that we can kind of quantify, and I'll have to go back and look at it. And with the benefit of hindsight, we want something that's fairly accurate in terms of timing and in terms of reliability. So what we do is we take the 12-month rate of change of the ratio between gold, remember gold leads to CRB, and on the other side of the ratio is the CRB composite. When that ratio peaks, we get a green vertical line. And you can see that all the green vertical lines, we've seen the takeoff.
It's a takeoff.
Up to the moon or beyond.
Now, guys,
sort of like
you
the
could
CRB
say that
composite.
I saw the launch to moon at WMD. Bruce, how cool is that? At the 500th episode.
I think that's pretty cool you brought that in.
Well, then it looks to me a lot like the CRB composite.
I'm thinking AI stocks like this right now. That's the cycle.
Wow.
Good luck to them.
News at 11. I love it.
Only at WMD. Oh my gosh. Oh, we have some people right there that could see this from their house. Pretty cool, John. Wow, amazing. Well, here it is.
Meanwhile, back to Earth. So that if you look to the right of the green lines, you'll see that invariably there's some kind of a rally going on. It doesn't look like some of them are very big rallies, but when you look at the dates at the bottom, like take the 87 signal, for example, it doesn't look that long a rally, but if you actually look at the dates down, it's about between 87 and 90, or 89. That's 2 years or so.
Yeah.
Some of them are really much more explosive. Like look at that one in 0102. I guess that's the best signal of all time. The one to the right of that yellow there.
Yeah.
that one.
Yeah.
And then we got some failures, as we always do, is nothing's perfect, and those are indicated by the red dash lines. And that one, the way you got your cursor right now, Ron, it's a really bad one because it's snicked up, and then of course we had the pandemic, and we had that very sharp drop that followed it. And that, unfortunately, is the way of life. It's nothing is perfect. But if you look at the pattern since 2024, you can see it's been zigzagging its way higher, and then reached a very high level in at the end of last year. Now it's come down sharply, and it's broken the trend line. So as far as I'm concerned, that's enough information to tell me we've got a peak. When we get a peak in that ratio where gold starts to underperform the CRB composite, CRB is going to experience a rally, and you can see that obviously it did because of the influence of the energy price. And also the point to bear in mind is that the CRB composite is breaking out of a reverse head and shoulders. It's the head and shoulders, the shoulder, left shoulder on 08, 10. Then we got the head in 2020. Then we got the little right shoulder, 22 to 25 or so. And that suggests that prices are going to go significantly higher. I didn't draw it in. You could probably draw a line joining a peak in 1980 all the way over to 2001, that great giant trend line there. And that was followed by a huge peak, which topped out in 2008 or 2000. I think it was 2008. So we're seeing a similar kind of breakout now. So I think we move to the next chart. We got the crude oil, West Texas crude oil, and we got this moving average volatility indicator, or what I call the MAVI, in the lower window. And you're probably not familiar with that, but what it is what I devised where we take 4 different price oscillators. The price oscillator where you take a short-term moving average divided by a longer-term moving average. We take 4 of those to get in lots of different time cycles and combine them into one indicator. When that's the solid black line, and when that crosses its moving average, that's when we get a green highlight. When it moves below the moving average, that's when we get a red highlight. So for example, it peaks out in 1981 over here on the left. There you go. And it crosses the average. See, you get a red highlight from there almost until 1986, but there's a little bit of green that comes in as a whipsaw. But generally speaking, it works out pretty well, and certainly keeps you out of the major declines. Well, sometimes those signals come a little bit late. So what I did was to kind of look at when you get one of these indicators, when you get this indicator to bottom out from an oversold level, and see what happens. That's what these green vertical lines are. You can see they've all been followed by a worthwhile rally in the oil price. Now, the oil price now is looking a little bit lagging what the CRB composite has already done. In other words, it's a big support head and reverse head and shoulders pattern. That neckline is around $115, and it's got to be achieved on a month-end basis. You can't do it today or tomorrow because at the beginning of the month, you have to wait at the end of the month because it's a monthly chart. And that potentially that hasn't happened, but given the buy signal from the MAVI and the fact that the CRB has already led us higher, and because the peak in that rate of change between gold and the CRB has only just taken place, it's not a big stretch to imagine that the crude oil price can move above that horizontal line and then move very much significantly higher over the course of the next 2 or 3 business cycles. It's not going to happen right away, but it sets the scene rather like the scene was set at the turn of the century with this other green horizontal line we've got here. It starts in 1982, and you can see when we broke out from that, we had a pretty good rally between the turn of the century and 2008.
Wow.
We just consolidated since then, and if it breaks out, we have a nice move to the upside. Well, I won't say it's a nice move, but unless you produce the stuff or you're long to stop, but a good move from from the breakout point. So what would that mean for you filling up your car? That's what we can look at in the next slide.
Did you want to say?
Okay.
This is the gasoline ETF, the UGA. You can see it's broken out of above a trend line quite decisively. It goes all the way back to 2009. So these patterns are huge that we're looking at today in the commodity markets. And it doesn't happen every day, obviously, because they're so huge. But when they do occur, they have a tendency to work, but over a very long period of time, obviously. And you can see the long-term KST, the momentum for the UGA, has just given us another buy signal. That doesn't mean to say that it's going up significantly higher, but it is obviously, if you're trying to get long this UGA, for example, it tells you you've got a lot more momentum, a lot more potential to go higher than you would if it was up where it was in 2022, where it's coming down. Obviously, it's very overextended right now and due for a correction of some kind, but it's definitely a decisive breakout to the upside.
One of the aspects of being able to study markets, certainly from an investment standpoint, I think gasoline or the prior oil chart point out to us, we can use this information in a lot of different ways. And certainly Tina and I, based on a lot of Martin's charts here, my wife and I have had this discussion lately about, our next car, or we should be thinking about trading in our V6 Explorer for maybe a hybrid out there. Because to Martin's point, it looks like the price of oil and the price of gasoline can be moving up significantly in the months, if not years ahead. And certainly it'll have an economic effect, but it also has an effect on each of us in terms of our pocketbooks and how much it costs to fill up our vehicles and what sort of vehicles we drive. So I think there's a lot of information besides investment information. Thank you, Martin.
Thank you, Joe. So let's move to I think the last slide. And this is the silver price going back to the 1930s with a 18-month rate of change. And we wrote a book, the Pring boys, we wrote a book called Investing in the Second Lost Decade. At the end of that book, we had an appendix which looked at 30 different situations where the rate of change had moved, the 18-month rate of change had moved above the 200% level, in other words, doubling. And what happened after, how long it took to recapture the ground to the actual high of that particular move. We found that it took 15 years on average once you peaked, once the momentum had peaked from a reading above 200%, that it took 15 years to get back to the highest level of the previous valley. And you can see that we've had 3 previous buy signals with silver. That one in 1980, by the way, was the record of all the 30 examples that we looked at. That was at 500%. And nothing came even close at the time. In fact, since then, Bitcoin has lasted through that record. I think it was 7,500 or something it got up to. But the point I'm making about silver here is you can see that it peaked. It went up through the 200% line and came back down below it, and it looks pretty well as if it's peaked for this cycle. Usually when you get these exponential moves, they don't, once they peak, on your way to the peak, they tend to be pretty smooth, and on the way down, they tend to be relatively smooth, or if they're jagged like the 1981 at a lower level. So it seems to me that the silver one has peaked now because it's back down to 150. And that also spells trouble for gold, because silver and gold often move together. Not always. There are obviously some differences when they don't move together. But generally speaking, when gold moves up or gold moves down, silver goes with it, or vice versa. So that's a warning, I think, for gold as well. The long-term indicators, momentum indicators of gold have not turned yet, so they haven't given us a signal. But I think, given its connection to silver, and the likelihood that silver has peaked for this cycle, the gold has probably done sort of the same thing. And remember, that fits in with our cycle of gold, copper, and oil. Because when oil bottoms, the next event in that sequence, that triple sequence, is for a peak in gold. I don't know if you guys want to debate me with that, or pat me on the back or whatever, but that's the end of the presentation.
Well, Martin, that's amazing. As a matter of fact, we have a special offer for our attendees and a free gift from you. And I apologize because I had a blue background, which you Pring.com stood out on that, but I messed that up. But anyway, you go to Pring.com, and if you go at the home page there on the left side, you'll see the Intermarket Review. And if you click on more information, there's a button at the top which gives you a free copy of the Intermarket Review. And Martin has generously offered us a free copy of the hot off the press, freshly printed just yesterday, last night, the April issue of the, and of course the April issue is all important because it encompasses the very tumultuous first quarter of 2026. And all you have to do is click on that and it's going to give you that April issue, which is amazing and remarkable. Martin, thank you so much for doing that. But then the second part of the offer is, and there's a time limit on this. So if you go to the bottom of that page where the more information is, you can do a trial of the Intermarket Review. Normally 3 months is $75, and they're offering a 3-month trial for just $45. So $15 an issue for a 3-month trial. And so you can go right in there, go to the bottom, and all you have to do to get that special price on the trial is hit WMD and put it in the code, the special order code. And you put in WMD and you're going to get that special price. So that's remarkable. And then Joe, any comments, questions, thoughts?
I think I'd like to add something. I know this is not, it may sound like an ad for the IMR, but it's really what I want to do is pass on to the listeners or audience here the work that you're seeing here, and the work that, for example, is in the IMR. What Martin has done, and I think this has been a joy being his partner for many, many years, decades. He took research that was going on in the business cycle world, and actually it was done more from an economic perspective, or if you were a business person, how to use it for inventory control, or expanding plant capacity or things like that. There was not a lot of work and research done in the investment side of business cycles information. And so I think Martin, what he did way back in the 70s, early 80s, when he actually first started publishing the IMR, is to put, let's call the business cycle itself like the skeleton. Martin put skin and muscle and features onto the business cycle from an investor standpoint. And I think the asset allocation work is what he's done. And I'll tell you, it's opened so many doors for so many investors to better understand how to invest. So as much a tribute to what Martin has done as the IMR, and I think he's been doing this for like 40 years. We, on the other hand, we, his partners, can thank Martin for ruining our weekends every week for the last 40 years or so, because he sends us the charts that are in the IMR. He sends us a package every Saturday, and there's anywhere from 60 to 120 charts of Martin's favorite observations. And of course, what is in there are trends and sectors that are doing well, but intermarket analysis it's also helpful in how is this group compared to that group. In other words, relative strength among assets, relative strength among sectors. And that has been what has been so useful to manage portfolios and to avoid, the bad places and be in the right places. So that's kind of the pioneering work that I attribute to Martin for a contribution to business cycle analysis. It's really how do we invest around a business cycle, and he's given us an awful lot of tools for that.
And by the way, the Intermarket Review, which has 50 plus slides, it covers, all of those important relationships. And you're going to see this when you download the April issue, is all those barometers that Martin profiled, including the stock barometer and the bond barometer, and then he summarizes it with conclusions, and all this other supporting information for all these markets is in there. And it's, I don't care if you're a swing trader and you're operating in the shorter term time horizons, you want to be swing trading in the markets that have the best upward momentum. If you're short seller in the most important downward momentum, those are the markets. That's where you want to be. And Martin tells you well ahead of time, where those trends are going and how they're emerging, which he showed today. So this is really special and a great opportunity. So please do check that out, that April issue, and do the trial. It's like, give it a go. It's a remarkable tool. And Martin, any thoughts? Any capstone concluding thoughts?
Well, be very careful when you handle that April issue, because it's extremely hot right now.
It is. It is. And Martin, thank you so much for doing this for us, because Martin has concentrated 100% of his attention on publishing the Intermarket Review, and then he does a summary, a very light version of that in stockcharts.com, which subscribers can read, who are subscribers to Stock Charts. So you should check out what he writes there every week. And Ramon, any thoughts for Martin before we kindly let him go?
Absolutely. There is one thought here, or a question. Oh yeah, I don't see the gold chart. Hold on a second. I'm gonna get to this really quick. How about this one right here? Martin, Altor is asking, if we see gold from the trading perspective, we see the making of an accumulative behavior after that 4,400 has been taken. So from Martin's perspective, is it likely that it wants them to take that range at 5,600 again? So the question, if the gold will go to the 5,600, Martin, how do you view the gold at this point?
I'm just trying to come up with an answer, because I think gold has peaked, and I had some charts that show that it peaked on using a weekly bar chart, but we didn't have time to really go into that. That's why I used silver. We've been recommending gold in the IMR probably for, I don't know, since around when it was around 2000. And we gradually started getting out of it. And in the latest edition, I recommended getting out of it. And I think it's oversold now, so, on a bounce. So I'm not really very bullish on gold right now. I've been all the way through it. That's an interesting chart you got there. Is that a daily chart or?
That's a monthly.
Okay, well look at that big outside. Well, I call it an outside. There's a candle, engulfing pattern. That's a huge engulfing pattern.
Mhm.
The red real body engulfs the green real body before it. And that,
Martin, let me engage with you a little bit here. I'm looking at this. Are you looking at this right here into the
Yeah.
end of it? Yeah, definitely, you know, two tails. We have like supply coming in. There is demand here as well. I would be thinking like some kind of trading range at this point. And we could have like a trading range like we had in 2011, 2012. We could have like decline. We could have a prolonged inactivity by the institutions. And that's has been kind of a very common pattern here. One thing when Bruce and I were looking at the long-term charts of gold, we were noticing how the texture of how the price moved up right here, this last move, this is probably texture-wise is such an improvement by the demand. So there is a lot of buying, and we see that accumulative volume here, right here, back in 2015, 2019, 20, with some pickups in 23 before this move up. Usually, you know, historically, when we look at the moves like this, unless they're extremely climactic in nature, right? So like have that type of a lot of effort coming in, volume average increasing by a factor of, you know, 2, 3, 5, 10, something like this, then we have like that stop in action, climactic action, then we go into this period of inactivity. Does that feel after this improvement by demand? That's probably the best rally that I see here on gold futures, just this chart. Does that still mean that we're gonna go into very prolonged inactivity and some, you know, meaningful decline after this type of strength?
I don't think that characteristic tells us that it's a bear market, but what it does tell us is that it's a reversal point for at least on an intermediate and could well be a primary trend or even a secular basis. But it's going to slow down the advance, and in the process of slowing down the advance, you look at something like my special K. I'm not even sure if you're familiar with it, but that's a momentum indicator where we had the short-term momentum to the intermediate to the long-term, and it tends to peak and trough almost simultaneously with the market that it's followed on a primary trend basis. Obviously, it's not perfect, but it does it with a great deal of accuracy. I'm just putting up on another screen, which I guess I should have put up for you guys, looking at this special K, and it hasn't reached it's only reached the level it's at right now, indicating that on a very historical basis, the market's overstretched. It only reached it once, and that was in 1980. When that turns, it's consistently given sell signals lasting at least, or usually, well, actually, I should say, of different qualities. Sometimes it's a secular reversal, like it was in 1980. Sometimes it's a cyclical reversal, like it was in 2012. And sometimes it's just an intermediate signal, like it was in 2000. But because this indicator is so high, to me, it's indicating tremendous positive psychology, which is from a contrarian point of view, and looking at that engulfing pattern you've got there on the monthly chart. Remember, it's a monthly chart, so it has an effect for at least 5 to 10 months, as opposed to happening on a daily chart, maybe 5 to 10 days. So that has the effect that says to me, this advance is really slowed down, and in slowing down, it's going to also push over some of these longer term indicators. It doesn't mean to say you're in for a huge negative bear market, secular bear market. You may be in for a sideways period like you were in 21, 20 to 24. But it means that, to me, it says there's not much future in gold over the next period or so, next year, maybe 2 years, maybe longer.
Yeah. And I think, Martin, you're so right, you know, like stating it this way. It's not that gold on a secular basis is not bullish. But it's definitely a much prolonged intermediate consolidation, which could be downsloping.
Yeah, I mean, of course, it's there. Why would I buy it when it's like that?
Yeah, like what's the trading edge here, right? Like from institutional and even retail point of view, like there is, unless you're intraday trader, very short-term swing-oriented trader, there is no edge here.
And even then, you've got to be careful because the contra-trend signals are the ones that are going to fail.
Exactly, because the volatility of the trading range is going to increase the presence for both, especially at the beginning of the trading range, right? And then the inactivity later on is going to kind of, the collapse of that volatility is going to kill you as well.
I mean, I don't like selling the gold because it kind of keeps me happy or contented. But when it's acting more like a top than a bottom line, I have to say to myself, why would I want to own this stuff?
Yeah, so you like have your trading hat on, but quick anecdotal story here. In 2016, when we started the program, WMD, together with Bruce, we were following gold, and both of us were started loading up on the long-term positions here around 2019. I was buying just ETFs, GLD, because like I knew it's going to be a secular trade. I still have it, and even at this point right here, with all of these profits, and it sits in IRA account, so like I'm all good. Like I don't need to move, I don't need to do anything, because even if I go through like years of this, and let's say, or maybe a year or two, there's going to be some continuation of it, just because the strength of it is really, really, standing out.
Let me add one other observation to that. Keep in mind, there's a difference between gold and the companies, the gold shares. And I think what's fascinating, if you looked at a very long-term chart and compared gold to the miners themselves, you find a fascinating picture out there that it could be the XAU to gold, or the what is the HUI?
HUI.
Gold
bugs.
Yeah, the gold bugs index. When you do that comparison, you find out that the shares are not nearly as expensive, in their history to bullion. That bullion compared to how overexposed or overvalued bullion is today. So take a look at that. There's just a tremendous, I think, still an opportunity in the shares. Can you do a ratio there, Ramon, between?
Yeah, it's HAU
and gold.
Gold, okay. Is that what you're looking for?
Yeah, and a long-term history.
Okay.
So consider that ratio today is not much different than the low you reached back in 2000, 2001. And consider that the ratio of the miners to the product that they work in, not much difference. Now gold, if you go back, gold was selling for 250, 300, 350 back in 2000, 2001. I don't know what the profit margins were at $300 gold, but at $5,000 gold, I think their costs are about $1,600. So they're making, $3,400 an ounce. And yet look at where the shares are compared to history. So I think there might be opportunity. That's all I'm suggesting there. Keep in mind there's a difference between bullion and the shares. That's all I wanted to touch on that, Ramon.
Mm-hmm.
So
All
you're
right.
saying that the gold could go down 90%, but silver's but the shares are okay because they only go down 80%. Is that right?
Or maybe 79, 80, 81. Yeah. But you're collecting dividends too, Martin, don't forget.
All right. Yeah.
All right. That's funny. Well, Martin, you're an absolute treasure to technical analysis and to our industry, and I've so appreciated your mentorship and your friendship over these years, and I look forward to many more years of that.
Well,
So-
thank you very much, Bruce, and I'll certainly make sure you get that payment we talked about.
and Martin doesn't do these anymore, so this is a very rare occurrence. So it's doubly special, So
Thank you, Bruce.
Martin,
And-
we really appreciate you being here. Thank you so much.
take it away, Ramon.
Okay, we're done with this segment. All right, thank you guys, Martin, Joe, Bruce, thank you. So this is kind of like a big view picture for us. Now let's go further down the line, down the rabbit hole, and let's look at some branches and leaves. Today we have Wyckoff Analytics team with us. As I mentioned, Alessio, is such an important part of our contribution to the Wyckoff analysis, just in general on the daily basis. He is leading the crypto Discord group. He is publishing the market report. He is developing a lot of software packages, whether those are PNF or whatever else he is developing right there. So pretty busy contributor for us, and it's always a pleasure, Alessio, to have you here.
Hi, Roman. Hi, Bruce. Hello, everyone. I'm so glad to be here celebrating with all of you this milestone. Happy birthday.
Thank you. Yeah.
Alessio, it's so great to be with you again. So
Yeah, and by the way, guys, like when I tell you that we have, a team, every team member, I kid you not, every team member came from our student body. Well, obviously, except for Bruce. I was the student of Bruce and Hanks, at Golden Gate. But this is how we are, and we are always looking internally into the talent. And Alessio, so great to have you here. This was an amazing call. Called both by Bruce and Alessio. Back then, early in October, November, we started talking about Bitcoin diminishing the dominant force, which was to the upside through the larger structure. And then locally, we started seeing some elements where supply started to improve, showing some selling. And Bruce, that was your call, but Alessio, I also absolutely recall how in your crypto discussions you started pointing, to the downside with specific targets, which both of you nailed completely. So, guys, take it away. How did you see it back then?
All the credit to Bruce.
well, I follow Bitcoin because so many of our community are interested in it, but also because Alessio this is his space, this is his world right here, and among others, but this is something he's so good at, and I pay attention to it because I was inspired by Alessio. And Alessio, I look at this structure and I go, this is classic Wyckoff. And I saw this and I said, this vertical structure is begging to be analyzed. And then also from there to be counted from a point and figure perspective. And so that's kind of really where this came from, was, doing the Wyckoff analysis on it, because I think it's a classic case study. And so there you go. And so basically what I did is on the point figure is I just segmented it and you can see the widening out. And if there's anything that I would like to just express as a Wyckoff concept for people who are, Wyckoff oriented, is when you get a widening structure like this classic widening or increase of volatility is a sign of the control of this asset being turned over to weaker hands. And it's a sign of distribution. And note how over here with that LPSY, after that upthrust, that LPSY comes in after the sign of weakness. And notice its inability to lift much beyond the that area of resistance overhead, and then starts to collapse right down to new lows. This has been a very weak structure, and then we can see what happens subsequently. But those are just my initial thoughts, Alessio.
Yeah, I think that another powerful signal, that divergence on the relative strength ratio, that's really, really powerful. We see that new high, that upthrust after distribution on Bitcoin is not aligned with the relative strength ratio. So that was really a precursor of weakness. And for example, at that time, we didn't have any new high for Bitcoin price in euro and other currencies, another strong divergence. So there were many elements at that point pointing to future weakness for Bitcoin. And we have to keep in mind that at that time, the upward potential had been consumed. And we will see this in the next 2 slides, but this chart was really, really powerful. And congrats, Bruce. This is such a great analysis. Spot on.
Thank you, Alessio. Well, you inspire me to follow this market, and it's just, the one experience that I have with Bitcoin, just for people to follow along, is that Bitcoin really does work well with point and figure, and nobody does better point and figure for crypto than Alessio does. So that's one thing that I think is a very unique feature. I don't know, Alessio, and you may have thoughts about this, but I don't know how anybody can trade crypto without doing point and figure analysis.
I agree with you. I totally agree.
Oh my gosh, it's just too volatile and moves too fast, and you've innovated some very important point figure technique for the crypto markets that I think is incredible. So
all right,
Yes.
well, guys, I mean, like, this is like such an amazing call by both of you. We are here, right? So we've satisfied the price objective of 60,000.
early February. Alessio and I like to joke, it's like, isn't it amazing when this point and figure stuff works? And look at this count. It touched 60,000, and look at the count objective. At 60,000 is the lower count. It's like, bingo.
Mm-hmm. Well, I guess like the biggest question is, where do you think we are right now with Bitcoin?
I'll turn that over to Alessio.
I think this is probably phase B of a consolidation. I look at that volatility that we had lately, and that's not so great. Generally, we had this volatility in phase B, or in a redistribution. So I think that right now Bitcoin is trying to establish a pattern, but I don't see that demand coming in. We have just demand, very high volume spike at the beginning of the formation, but after that, value buyers are still sitting on their hands. So I think this is probably just the beginning of a way more complex formation. So remember, this could be the primary support or the selling climax. And after that, there's a lot of work for bulls. And I think, Roman, that here the key problem with Bitcoin that historically, even when we have the beginning of the accumulation phase A and phase B are quite muted. Historically, we don't have big automatic rallies for Bitcoin, even in the accumulation structure. So this is something that we have to keep in mind. So we are probably at the very beginning of the potential accumulation. It can take 1 year. And I totally see the case for Spring lower prices here. So the first start, the maximum target has been fulfilled, but remember that Bitcoin loves to overshoot the target. And in this case, we can easily penetrate that support area. And for example, I really love this idea of the downsloping trading range that you are drawing, Roman.
Yeah, I kind of have probably similar view, Alessio. And your thought here in terms of being in the middle of the trading range in phase B makes a lot of sense to me, right? We clearly see the stop in action. The incoming demand is one of the largest, for a while. So this is clearly like a stop in action, like whatever we had here. The structure here shows some improvement over this. So demand is definitely better. So it has a little bit of a bullish kind of like connotation there. But it doesn't really go anywhere. So this would be the sign of phase B. And also it has all of this supply spikes, even though supply is low, but the reactions are pretty deep, which is very characteristic for phase B. Now we could be in that, and I think you're alluding to this with the low volatility in the second part of phase B. So having increase of volatility, right? So where locally liquidity event where volume increases brings more buyers and sellers, create that spring opportunity, extension below the stop in action, but only temporary to retest and then have a sign of strength. Makes a lot of sense to me. And to your point that it takes time to build a causality. I've been using and showing our students here in WMD this pattern right here, right? So like the top and then a move down as a fractal of what we had here back in 2021, right? So we have like that in the middle trading range, which is the pennant or a flag, right? Bearish flag. And then we've talked about first move down, second move down. So we could have even more move down into the climactic action. But let's just imagine that this point here fractally corresponds to the stop in action here. Look at the volume, by the way. This is a perfect volume analog to price analog. So we're seeing that first change of behavior, which is the improvement of demand, right? Somewhere here, higher highs, higher lows. We kind of see the same. It's a little bit weaker. So if it's weaker, the possibility of the spring kind of increases. If we were to have like that final goal of like around like into the low 50s, into this area where demand was very pronounced, very aggressive off the bottom here, and into this impulse, this breakout, where also volume profile finally started to decline right here. So we could potentially have this, Alessio, as you're describing, into the spring, more liquidity comes in, and then we go into that final change out of the trading range with the backup, and finally we're starting off. So I like this scenario that you are describing with more time at this level.
Yeah, we are really in the early stage, I think, Roman.
Okay, yeah, it makes perfect sense. I love it. Bruce, do you have any additions to that?
Well, just that, there's a lot of commonality between that structure on the left, 2021 to 22, that's a distributional structure, and how it just persistently would redistribute itself and go down. And I think that there's similarities to then and now. And so I believe that having continuation of this downtrend, and like Alessio says about it being able to overshoot, there really is a bigger distribution structure than the one that I counted. And that, you know, I always like to be conservative in my counts, especially with distribution, and be careful. But in the case of crypto, I think it's such an emotional market that it easily could go down and go to the lows that were made back in 24, and maybe take those lows out before this thing is really done. So because there is a bigger structure of distribution than what I counted. And so it probably would behoove a crypto trader to take that bigger count and just be alert for that.
Yeah, and I took the count a couple of weeks ago, Bruce, and that go to 52. So 52 is another magnet there, important magnet. So
very good job, Alessio, because I totally believe that this market could just, you know, continue to. And note this about these two redistributions that we have, assuming this current one is a redistribution, and go back and look at that 2021 affair, is that you can see that the last thing it does is it upthrusts before it starts down again. And you'll notice that at the distributional top, it also upthrusted before, even though the relative strength made a lower high, it upthrusted before it went down. And so these upthrusts are sort of the final act in the trading range of distribution or redistribution before it starts down again. And right now it's going down off of an upthrust. So these are very important places, and it tends to be a characteristic of the way that the CO types trade Bitcoin.
All right. Okay, shall we move on from Bitcoin?
Carry on.
All right, Alessio, you still
Yes.
with us? Did we
yes,
lose you?
yes.
Oh, okay. All right, yeah, so let's look at the PNF. This is, Alessio, at the top, this is your software that you're developing.
Yes, absolutely. And we have percentage scaling, and Bruce knows that I really love this technique. So basically, we are looking at the macro chart for Bitcoin. We have the first accumulation structure many years ago, and then we have this local accumulation structure of just 15 boxes, the latest structure. So we can clearly see that we have consumed all the potential to the upside, and we were signaling this already between September and October. So just prior that big drawdown that we're seeing lately. And now when we look at the weekly chart, we are sitting on the 200 weekly moving average, which is in the past has acted as a support. But look at the price behavior, for example, in 2023. So the price action was able to reside there below that line for a long time. And I think that this is very likely right now. So we are right now we are interacting with that line, but I think there's a lot of work to do here. And on the weekly chart, for example, we have multiple volume spikes. Here we have just one volume spike. So that institutional presence, it just, you know, we just have 1 week, a couple of weeks of institutional buying, value buying, and after that, nothing. This is not how the accumulation works. We have to go through the absorption process, and we need multiple spikes there.
What a great point, Alessio. Just, yeah, awesome. I love that. And look at like the trading range right here, right? It's logical that we are going through the same process, some kind of trading range. Okay, yeah. Bruce, do you have anything to add here? And could
really
you comment on the software? Look at that.
Oh, yeah, it's unbelievable. And Alessio, it's like you know, hats off to you for this remarkable tool you've created for us. But let me just say about percent scaling is that you know, Wyckoff Analytics, we have basically taken percent scaling to the Wyckoff horizontal point figure counting conventions, and you know, we had to make adjustments for that. And Wyckoff Analytics, especially Alessio, has really carried the ball on developing the tools to be able to use percent scaling for price targets. And I just want to make the point that, first of all, that Alessio's done a tremendous job here, but also that percent scaling, to do a 10% scaling for crypto and for Bitcoin is just it's an ungodly percent. It's huge, demonstrates massive volatility. And you know, in the stock market, you'd never use percent scaling of this magnitude. And it's just remarkable to me. And it also tells me just what a beast crypto is for trading. And this is exactly why you need point and figure analysis, and in the way that Alessio does it, to be able to trade this beast.
Yeah, Bruce, I remember the first time I showed you a 10% scaling chart, and it was like in 2018. And it's so great that this box size is still working on Bitcoin. So the behavior is still, is still consistent with that huge box size.
You scared me with that. So it's amazing. But anyway, everybody follow Alessio's work on this, because he's taken percent scaling to the next level.
All right. Well, Alessio, we also want to know your opinion about the market. This is not the latest update, obviously, on the S&P. So let me just go here and give you like a fresh look for today. What are you thinking for the S&P and just the markets in general?
Well, we have just reached a very important support level. I see that we are creating probably the best rally since the beginning of the downtrend. So it looks like an automatic rally. Honestly, I would have preferred much higher volume signature on this pattern, and the fact that the volume even today is still like it's high, but not the highest volume signature that we had, for example, many months ago. This is a bit concerning. So I'm thinking, Roman, that this could just be the beginning of the consolidation. We could spend more time and retest that low later on.
So something like this.
Yeah.
And then are you like thinking about like the lower low here into the spring, or like what you're describing in Bitcoin as well?
Well, it's very early to say that, but I totally see the case for that.
Okay. All right. Well, Bruce, we're gonna go through the markets.
Yeah. So hearing Alessio's view on that, and I love it. It's very good. So.
Yeah, and we'll be asking Antal as well, but let's come back to the slides. We have another slide for you, Alessio, here. Bruce, you've been following AI, ETF, AIQ, bringing this to our attention. This is a pretty cool chart with the active volume or candle volume, because it just shows you how much of the effort is coming in on each bar, defined by the widths of the bar, so or the volume, expansion. You were calling our attention early on to the fact that the Mag 7 has been underselling, and we should expect weakness right there. So this is the latest. How do you see it now? Did we fulfill all of the objectives, and are we at the place where the weakness is done?
Actually, we did not fulfill the count objectives, and the structure here, which very much looks like distribution, has committed into the end of the first quarter to a markdown. And note that after that upthrust that we got at the end of January, and then a break, is that the market went into a prolonged February-March sideways trading range with diminishing volatility. And so there was no lift in that. It just went sideways, and look at the volume coming in. Very wide bars in January, February, and March, and no lift, which really says that there was a systematic supply present in this sideways structure, which looks to me a lot like the old school definition of ice, because it just laid there. And then the resolution of that ice is that, you know, you fall below the ice and then you bounce back up to the underside of the ice and then you start fading away. Look at the ease with which it goes down. So those candle volume bars are very narrow on the way down into the end of the quarter. And now this is through the 27th, so I think it got a little worse than that. But the you know, this now has the distinct characteristic of distribution, and this is in the AI space where there's so much bullishness and so much interest. And then I think, Ramon, if you look at the point figure on the right, you can see that initially, and this was back in February, beginning of February, you can see that I counted this as distribution, and you get 14 points of count down from that, which takes us to 39.5. And so we have not yet achieved that. And then I think if you hit the space bar, Ramon, I think I have an updated point and figure chart. Yeah, there it is. And so you can see that it did go down, but it went through this period of developing ice or going sideways with no lift. And then it broke down, but it only got down to around 45, 45.5. But look what it did, because if you count that as redistribution, you now have a confirming stepping stone redistribution count, 3950, 3950. And so I would be concerned that even if this market can rally in here, that there is the potential in the second quarter to see more weakness in this market, and maybe to achieve the objectives of the 39.5 target zone. And note that with the ice, that the distribution on balance is now even larger. So something for us to be very concerned about. And then also, if you look at the vertical chart again on the left, on the bottom is that all important relative strength line. And you can see the lower highs throughout here, which, you know, if AI is such leadership and so important, why is it starting to underperform the S&P on a persistent basis? So something for us to stay focused on in the weeks and months ahead in WMD.
Alessio, I'm gonna slightly update the vertical. I quickly created the candle volume. Any thoughts here on AI?
Well, that minor sign of weakness that we had many months ago, and then all this period with low volume at the beginning, lower highs. This is a pattern that I'm seeing on many assets. And by the way, Bitcoin was probably the first asset. And remember that Bitcoin generally tends to precede, a top in Bitcoin generally tends to precede other technological stocks. So what we are seeing here is basically distribution, and now we are trying to bounce, but I do not see active accumulation on the last rally. I just see a bounce. I just see an attempt to rally and retest that support, and I think that there are lower prices here. So I would take even a more aggressive count at this point.
I would even add to what you said, Alessio, by saying that even if, you know, you're going to get any kind of a bounce that we get now, we're going to address this more in a few minutes, but end of the quarter was characterized here in the first quarter by liquidation, by markdown. And that liquidation and markdown that we had comes after you complete some form of distribution. So you get distribution, then you get markdown. And we saw that there was an accelerated bouts of selling as we came into March 31st. And that those accelerated bouts of selling were window dressing in large part by the institutions. And this tells you that they're starting to see the footprint of underperformance in the relative strength. And relative strength is very important to us in WMD and in Wyckoff. And this was very much a technique of Richard D. Wyckoff, even though he didn't use the relative strength line, which is outperformance and underperformance. And we're seeing that the institutions are starting to look at Mag 7 and looking at AI and other things that were prior leadership, and they're seeing these deteriorating, and they're starting to try to find a way to reduce their exposure, and they're way over their skis on these stocks. And so it's going to take them some time to be able to distribute because they're all trying to rush out the door at the same time. That's why, in my opinion, that the market accelerated in late March into the lows, and why I think we're going to get a bounce. And as Alessio pointed out, we're getting a bounce on low volume, and that's because there's no good quality sponsorship of these stocks by the large moneyed interest, which is the institutions, and certainly by the CO class. They're not supporting these stocks at all.
Mhm.
Yeah, Bruce, and I just want to add that I follow this area very closely. And the first wave of innovation in AI between 23 and 2025 was all about new models, better benchmark, and so on. But since late 2025, we have seen another trend. And the keyword in this space right now is optimization, lighter models, same performance using less energy and less data. So I think that the technical picture and the fundamental picture are together here.
Very good. Yeah, that's such a good point. And then, of course, there was that Google technology that makes RAM more efficient, and a big sell-off in Micron as a result of that, and a big drop in RAM prices. Very surprising in the last week or two. So supporting your point, Alessio.
All right. Okay. Well, Alessio, it's always such a pleasure to have you here. Alessio and Joe are somewhat regular contributors to WMD when Bruce and I are unavailable. So, our community is so lucky, to have people like Joe and Alessio, because both bring their own experience. Joe from the big macro perspective, business cycle rotation, and then Alessio obviously adds so much to both the cryptos and the PNF work that we do here. Alessio, thank you. I appreciate it so much.
Thank you, Romano. Thank you, Bruce. Thank you, everyone.
Thank you, Alessio. Great to chat.
All right, Bruce. Well, from the cryptos with Alessio, let's go to our next team member, Antal Weber. Antal also has come to us from the students' body, and going through all of the steps that students usually do, WTC1, WTC2, then training. I think that we're really lucky to have, the key members in training that joined us back in 2023. Antal was one of them. And what a beautiful path Antal has been on, developing the skills of chart reading, and such an amazing growth. Antal is co-instructing WTC 2 course together with me. Just a quick introduction here for those of you who are new. These are our flagship courses where we give you all of the material that we have, where we build your skill to see this material on the chart. I always say knowledge is not the skill. I see a lot of knowledge hoarding, as I call it, quote unquote quote, from our students, just because you guys are so smart. And sometimes the mind goes into like, if I have more knowledge, I will feel more confident in my execution, and then I will have more profits. Unfortunately, it works in a slightly different way. Knowledge, as we go to more advanced levels of trading, is actually sometimes could be a negative thing, overwhelming your system and not allowing you to see the clarity of the chart. So sometimes we have to simplify our trading rather than be extremely knowledgeable. But to get to the simplicity, you have to go through the complexity. So WTC1 and WTC2 is that path. So if you're interested, sign up. And coming back to Antal, Antal, are you there?
Hey guys, hey Bruce, hey Roman, congrats on the 500.
Thank
Wow.
you.
Can you imagine
Yeah.
Antal 500 episodes?
I
for 10
know,
years?
I know. That's huge. But it's just I'm so grateful to be part of this community, and it's like more I'm listening to Bruce and to Martin and to Joe. I just feel like I'm just scratching the surface. From
Yeah, and that
of the
comes
technical
from
analysis.
you, like, yeah, Bruce, I remember Antal one week, like, and I mean, like, I can't even describe, like, we have amazing coaches right now. We have Antal, we have Tony, we have Bill, like, they all came from training at just like an amazing cast right now. And then Antal comes to me, Bruce, one week and says, like, okay, I feel like I'm so behind on everything. I'm just gonna just go into the charts and just spend like 10, 20 hours per day just working on the charts. So that's type of the commitment, Bruce, that we have a crazy, crazy level of commitment.
Love it, Antal. I love it. It's like, that's, like I said, I carried in my hand, my grubby hands, Martin's book everywhere I went. And I still have that book, and it's just sad how beat up it is. So anyway, I get it. My advice though is don't spend more than 24 hours a day on charts.
Not
yeah,
advisable.
I'm trying, but that's, I'm trying.
Yeah, it's hard to stay away.
Yeah, that's for sure.
All right. Well, as with all of the team members, why don't we discuss the market first? So, Bruce, I mean, you started bringing to our attention the distributional labeling, Wyckoff distributional labeling, to the distribution that first we were describing as a local distribution in this range. And then I think that you've extended that a little bit more. You've been showing us since last week a possibility of the green shoots, where we could have some kind of demand coming in, some kind of reversal, and that's been obviously been happening. Just to bridge the conversation with Antal here, Bruce, what is your latest thought on the market? And then we'll just give it to Antal to comment.
Sure. I just want to go back very, very briefly and look at that buying climax peak of late October. And we had said at the time in WMD, because of the climactic nature there with the gaps and so on, that if it was followed by a very sharp sudden reaction, that this, after a long uptrend, was likely the beginning of a range bound structure. And we didn't at the time, we said it could be distribution or it could be reaccumulation. And so we would have to just watch how this market unfolded. And the thing is, you build a cause. And so you build a cause for one or the other, and they have distinctly different characteristics as they unfold. And so you could see here that there was some attributes of distribution occurring as the S&P was moving across and unable to break away and continue on above the resistance zone defined by the buying climax. And so we started, talking about this as distribution. I started labeling it as such, but I said the important thing that needed to happen is that we needed to start to make signs of weakness to show volatility was expanding to the downside, which is a measure of distribution. And in fact, we started getting that in February and then again in March and a couple of occasions. And then into the end of March, you had acceleration into a local markdown. Now, local markdown, which took us below key support, is a really big sign that distribution is still at work and that we may be looking at further weakness down the road. But at the same time, we know how important the end of the quarter is. And so you could see here in the 10-day advanced decline oscillator, which is a great tool for identifying strength and weakness, that we had green shoots developing into the lows where that major sign of weakness labeling is. You can see that it was already walking uphill. The internals of advancing and declining issues was showing elements of improvement. And that tells us that we're going to get potentially a bounce. Sure enough, we have a bounce. And this bounce, which this is through the 30th, so it doesn't pick up the strength of today or yesterday and today, is that, I believe that there's a good chance we could get a relief rally in early April because the institutions accelerated all their selling, their window dress selling of the Mag 7s and the AI stocks, which are larger cap, into the end of the quarter. And the market can rally just on the relief of the exhaustion of that selling. And so I believe that's what we're experiencing now in a nutshell.
Antal, and let me give you a chance to, comment on this as well. And just to update the vertical chart, I could give you the S&P right here. So how do you view the market right now?
Yeah, absolutely. I agree with Bruce, right? So let me just grab this pen, Roman, right? So we were looking at this area here, right? The break of this ice we were discussing, because we kind of had decent support here, right? And then look at the weak rally that we're getting here. And then a flush below into significant support again, and then we have better demand coming in, but the follow through is pretty weak, right? Demand is diminishing, so pretty much the same. We're having the same sequence here, right? So attempt to stop and then a weak follow through. But this it's like the best recovery out of all of this previous ones, right? So we would expect a better rally maybe into kind of like this ice level, right? This minor ice level here. That's how I would look at it. But still weakness. Like there is a lot of work to do here.
And then when you say
Antal, you always start these bounces with really big positive days. You get a lot of good positive volatility, and you don't need a lot of volume necessarily to produce that. But it's towards the end of the bounce, which could be weeks from now, where you start to see diminishing spread. It starts to have labor as it tries to go up into overhead resistance, possibly where PSY is. And all that does is it just makes for bigger distribution, which is, countable as a distribution on a point figure. And so I think if I was to add anything to what Antal said, it's that, we may spend time trying to go higher and finding less and less good demand on the way up, which is measured by reduced spread, reduced volume, and a slowdown of the advance. And I think time will tell.
And what do you guys think? Like, okay, I could definitely see this is better. This is an improvement. We already saw the improvement right here, so this makes a lot of sense that it's continuing. All right, so let's say like we have the best rally here. And I think that both of you are kind of implying that this is a relief rally. So therefore, I'm interpreting your statement as a counter rally, right? So meaning that we're still going to have some kind of either retest or even a lower low. Is that what you are both kind of alluding to?
I mean, personally, if we undercut this, right, I think we're gonna accelerate because we are below the ice here. We're holding, and this is a pretty big structure, right? If we look at this whole cost, if we break here, we might accelerate because we already have different strides on a downtrend, right? So we were looking at this initially, and now we're looking at this, right? And we can get back into it, right? So we if we break here, I think we're gonna accelerate, and we might go even lower into this levels right here, where we can find some support. Yeah, so we kind of, if this gets retested, but it's not like Bruce was saying, right, on maybe a lower high, and then we kind of want to see the spreads on the reaction diminishing and the volume dropping significant. So we see supply diminishing, right, like analoging to this area, let's say, of supply. I'm sorry, Roman, if you can bring this up. Yeah, so kind of like we want to see less supply than this on the reaction, right? So and lesser spreads as well. So we kind of see like how the power is shifting, right? How like the good demand comes in, and then a break back into this area here in the trading range.
Yeah, what kind of is not compiling for me in this picture, and I know that a lot of technical analysts already talked about this, coming into the same area, like we are looking at this, this, and this. There are some significant volume spikes. Here we have just a consistency of both supply and demand and directionality to the downside short term. So as the price comes in, it seems like, well, there should be some spike. Well, there is, but there is no continuation of that spike. There should be some spike here. There is some spike, but there is no continuation to that. So there is no climactic selling, and there is no aggressive institutional buying, as the price goes down. So just to kind of like breach this a little bit to our slides here, let me just go to the analogs that I was looking at this, and I wonder what both of you think about this. Like when we look at 2024, and we went through this multiple times here in these classes, right? So we have some kind of, significant impulse where the institutions are buying. That buying is aggressive, whether they are buying all, into the bottom of it first, right? And then we have like a free move to the upside where the dominant force is clearly seen. Then after that, we start to deteriorate. I'm pointing out to the same fractal from 1 to 2 to 3 to 5. And it's just the only difference here is that the current fractal is smaller. So therefore, if we're expecting this type of move, probably a smaller move, somewhat. So what do we see in the way of how after 5 things develop? We have that first change of behavior, test, then we have this reaction. Now, this is already oversold condition here. We talked about this in the last week, right? So we're seeing by the sentiment, by the breadth, by the put and calls, that this is an oversold in a potentially, much bigger picture. And we see how into this point, the volume signature actually increases, right? This is so interesting. Here, it's actually decreasing. So a bounce comes out of the oversold condition. And I think this is better because the way how it's so overlapping on the way down, the texture is just like more bullish here. So I wonder if what your guys are talking about, like, yeah, could we have a relief rally, but then could we have some kind of liquidity event that would increase, institutional presence, participation into some kind of oversold condition? Prior in this structure, we have actually went into much more significant lower low. This was an event, the April Liberation Day, right? So like tariffs and so on and so forth. Now we have Iran news cycle. So I wonder if all of these talks about the peace fail, troops on the ground, and then we have some kind of like mini repeat, maybe into like some previous levels, maybe like in the area where we have the oversold on the support line, maybe slightly lower, maybe like into that 6,000, slightly below, and then we build something here before we start to recover. I think this is also, could be a possibility of looking at how this developed here. Until, well, are you seeing the same pattern here, like, in terms of the analogs?
I mean, we definitely could. Yes, if this fails here, this point, if we don't hold right this support, because also like you said, so this feels more bullish, right? It's not as vertical as this, right? We're not accelerating down straight, right? This is not a trend here, right? It's just down, down, down. This we have some rallies here. We have those significant bars without follow through, and then this volume it's pretty consistent, right? So if we fail here, yeah, I mean this point should be like a lower high below the ice here, and then just flush in probably, yeah, like this area in 0.10. Yeah, that would make a lot of sense. But then like a flush and recovery, right? To print something like the rally that's gonna follow, it needs to be better than this,
Mm-hmm.
right? In order to show improvement, like to be consistent. Because then if we just start hovering around here, like we spend time, we could even go lower, right? We could retest this if we don't lift here at support once we get in oversold.
Mm-hmm. And again, our message with Bruce has been for weeks, like you could look at a lot of technical stuff, but the news is news. It comes and, it changes. There is a lot of, those up bars that we call candy bars that is just like in the downtrend, attracts us. There is some improvement on those. It could be, and then, the counter rally could improve. But it definitely feels better both on the decline and on the move up than in its counterpart back in 2025. So I'm not expecting an increased volatility, but if it look the same, right? If volatility would be the same, could we go to the lower extreme? I think this is really bad news. Something where like oil is above 200 type of news, so a very rapid discounting of things. um, you know so I wonder if we could have that, but maybe like a more localized volatility, like into the previous level rather than the next one. Bruce, what are your thoughts here?
Well, it's a little nuanced, but I think the institutions are buried in these Mag 7 stocks. I think they're buried in these AI stocks, and I think they have so much of these that it's going to take them time to be able to distribute. If they can issue or generate a rally, a meaningful rally in these stocks, they're going to do it, because a rally gives them an ability to be able to generate liquidity from the public that they can use to raise more cash and reduce exposure. And the thing that happens in distribution is when you finally get a rally. So let's say we get a rally sometime early in the second quarter, the rally could go up enough that it encourages a lot of people, a lot of opinion makers on Wall Street, et cetera, to say the decline is over. We're in a new upward leg. And so rallies to lower highs are designed to convince people that there's a good bull run taking place and that the prior decline is over. So that's what an LPSY looks like. That's the psychology of an LPSY. Let me show you what I mean right on this chart that you just put up. Look at the middle of the first quarter of 2022, Ramon. That is a late stage LPSY rally. It almost gets back to the prior highs in Google. See that? Well, the whole market could do that, where it like runs up to either the level of the PSY, or maybe it even gets close to the buying climax. And everybody says, you know, bear market over or correction over. And then you have the more important decline come. That's what an LPSY is designed to do, is to trick the majority of people into putting money back to work in the market, because the institutions need that liquidity to sell more stock. And that's their nature. And so it could very well be that we're in the early stages of something like that happening. And I expect it'd be a lower high. It could go higher than anybody expects, but I still think it's a lower high, and all it does is it just makes the distributional structure bigger. So that is kind of what I'm testing for in this rally phase that we're in.
Thank you, Bruce. Antal, I'm looking at this chart. I mean, obviously we had a high low right here. It was such a great call from you in this consolidation right here to pick up Google and have a trade right here. We're seeing some exhaustion go after the selling is coming in. Selling then influences the price down. Demand diminishes significantly. And now we are close to the moving average. We're close on the relative strength moving average. We have some pickup in the demand as we go down. And this is probably the best two bars that I have seen so far, like anywhere here on all of these takeoffs around this area. And that is after very, very strong rally. So the retracement itself is minimal. So what are we seeing here? Is this just a bounce, or is this something more as like an attempt to continue its secular trend?
So I was looking at this latest rally here, right? This area of the 200-day, like an improvement over this, right? In the similar area, right? We're coming into support, we find, and then we're traveling kind of easily. The spread is improving, right? We're also gapping up. Here we clearly had supply coming in, because after the event we have shortening of the trust, right? After this event we have shortening the trust, and then we have the change of behavior. And then this is the test of the change of behavior, a lower high, and now this flushing into the moving average. So the recovery, it feels better, but we're still below this, right? We're still under the ice. So this is just a backup, and the volume is diminishing. Relative strength is slightly improving, but we still want to get back in here. We want to get in this trading range, and you want to see that we're kind of holding the level here, right? And try to get back to the highs. Try to approach that. So yeah, I think there's a lot of work to do here. Actually, on all of the mags, they still have a lot of work to do.
Let's look at something else. Yes, right here. Let's look at Apple. Okay, what do you see here?
So on the Apple, I was looking at this support here, right? So we have demand coming in here. I think it's this, right? And we have a rally. Then again, the same idea. Demand comes in, and now, oh, this rally it's improving, right? The verticality it's improving, but it's a slightly lower high. So that's right away. It's a warning sign. It's bearish, and then. But this latest reaction, it's kind of diminishing, right? It's the selling. It's on low volume, and again we find support, right, in 2 points. So kind of demand is coming in. So yeah, Apple looks a little bit better than, let's say, some of the mags. But yeah, we need to see a follow through of this. We need to see a better rally here. What do you think, Roman, about this?
I'm seeing the same thing. Yeah, supply is diminishing, but definitely better than this. I'm seeing some like ease better takeoff, maybe a little bit here. Agree on the follow through. I mean, this is at the level, so I'm thinking here, Bruce, is it like if it's at the level, and even if we could have maybe like some kind of test later on, like price efficiency, is it here or not? What do you think, Bruce?
Well, I like that test that occurred at the end of the quarter because it didn't just fall apart with the rest of the market. So I think it's trading well, certainly better relatively. And the relative strength just keeps making higher lows. So I sort of look at Apple in terms of the Mag 7 as being maybe best of breed. And you know, having the potential to maybe have the better rally of this whole group. And I do think that the Mag 7s could rally pretty well, just because technology and the Qs are showing some relative performance at the lows compared to the S&P. And so Apple being best of breed could very well be the leadership and give the best rally phase. Does it get back to the highs? I don't know. I would expect it can't get back to those December highs, but I do think it could, you know, get back up to the top of the trading range.
All right. We have a question about NVIDIA, so let's go there as well. And until kind of like dipping again, the same idea, dipping below the support, but this is a very limited spring action here, right? If we look at more accurate support lines right here, we're not breaking through aggressively. So here we can't even come here, here, here. Yeah, there is still like that takeoff. It's not the same, but it's better than here. So is this providing us with enough support?
Yeah, also this latest rally, right, on the weak volume and the relative strength still making lower highs, right? It's still pretty weak. There is an attempt here to hold, but we could also, like, you can think about this two bars as an analog, right? The attempt to stop the move down, and we don't see such a big improvement, right? If it's something they quite the same, right? Or this, the latest, it feels even weaker because we're below the moving average right now. So you're gonna need strength to go through it, right? So we're gonna need the way we're gonna need this kind of volume, right? We need volume to go through a certain area of resistance. So I still see kind of weak holding, but yeah.
Okay. Bruce, how about Tesla? Look at this laborious move down, and wow, what a structure here. Bruce, what do you think? Have you looked at Tesla lately? Let me just give you even larger perspective here.
So I think that you can see that the relative strength just keeps trying to make higher lows against the market, and the pullback is still within the context of the larger trading range. It goes back to 21. And so I think what we really want to see from Tesla, if this is all an accumulation, and it could very well be, is that at this point, because it's at the top of the trading range, I think there's really no edge in trading this thing. If it rallies some but can't get to a new high, then maybe there's a bigger short opportunity there. But you know, that doesn't really interest me much. But I would want to see it show sudden volatility to new highs, and then be able to stay above the trading range and consolidate. That would be very constructive for higher prices, and would suggest that this is a big cause for accumulation, reaccumulation.
Mm-hmm. Interesting. Let me just kind of quickly, I don't need to do this, but was looking at this also recently, just better like this. So I'm looking at these two periods right here after the initial impulse, like this here, and then we definitely impulsed right here, then we had some of it here, and after that we go into the testing. So I'm seeing like this area here as an analog to this. So this is our diminishing demand exhaustion characteristics. So exhaustion, they both have this upthrust character just because of the strength that the pattern has out of the rally. And then after that, we go into the period of improvement by sell and deterioration by the demand downtrend. Improvement by sell and deterioration by the demand downtrend. So that creates that lowest low for the whole structure. And then it goes into the reaccumulation type of pattern. So 1, 2, 3, 4, 5. 1, 2, 3, 4, 5. So this is a slightly larger fractal right here currently. Although, who knows, right? So the same type of number, 3 years, like we're into this pattern. 3 years here. Wow, this matches. So this is a missing piece so far. And I wonder if we could get it. I wonder if we break these lows right here and we go into either this area right here or even slightly lower, and then we recover. And then the completion of the whole causality is there. And now we're gonna have like a more meaningful cause behind maybe like the robotics that they're developing at Tesla. It's not the cars, which they're gonna have the fleet of cars basically transferring us under the subscription model, but then also the subscription model for the robots that are gonna be introduced as like, you know, help us with built-in AI. So freaky, but I'm just thinking, Bruce, causality, like why would the course be here, right? Just to restructure the business, and then here it is, a multi-year course for higher prices with the new cycle of innovation. It almost reminds me of the history of IBM. For 100 years, the company has been reinventing itself first by reinventing the society. And Tesla is kind of has this type of, you know, secular quality to it.
I would just point out that if Martin is, you know, his scenario is right about oil and about gas and about higher prices ahead because of the secular uptrend, then I would think that Tesla could find that their automobiles are in high demand again.
Mm-hmm. All right, we are at 5:16. Let's come back to our slides and let's move forward a little bit. So Bruce,
Yeah, let
in
me just very,
Qs,
let me be very brief. And this was a chart we put up in 22 and 23, and this is a bull market accumulation point and figure structure. And we actually we have historical charts that we did at the time and posted them week to week to week in WMD. But here's the conclusion of that with an uptrend, and you can see that that count takes us up to 632 on triple Qs as a ETF of the NASDAQ 100. And then the reaccumulation in the April 2025 tariff lows matched that. It was a matching reaccumulation. And so they both reached 632, and we exactly hit that count objective to the box. It went to 637, and so that was a fulfilled count. And so now, if you just hit the space bar, Ramon, just to add, and this is October of 25 when I did that. Study, but the it's now complete, is attempting to complete a distribution, I believe, in the Qs. And so the conclusion simply is that we have fulfilled, used up all the fuel in the tank of the accumulation structure of 22, 23. And we need to do one of two things. We're either building distribution for a markdown, or we're building a reaccumulation of a large structure for the next leg up. And I still, it's still possible that that's what we have, is a reaccumulation that's still under construction and may have a lot more time to go. But anyway, there we are. So that's the main point I want to make with this chart.
All right.
Point and figure comes to the rescue.
All right. Oh, this is that last meeting piece.
Yeah, and that's not even up to date. It's a few weeks old, but you can see there that it's as it hit that 632 level, it just went range bound, and it's just been going sideways now for months. So
we've looked at that, the max 7.
yeah, so this is just a chart, candle volume chart of the mag 7, just so you can see it. You can see the notes, but look at the relative strength. So the mags made their highs back in October, November. They never did. The mag ETF never did go to another new high. And the institutions in Wall Street was just crazy about these stocks. They're so over-invested in these names. They're such a large market cap percentage of these indexes, which is just scary. And then you can see that I think the institutions are trying to get out of these stocks. You can see it in February and March, the way there's no lift here in these, and the other smaller S&P names are distinctly outperforming these stocks now. And I think it's because these institutions realize that they're buried in these positions. And I think that if they're not careful, they're all going to rush for the exits at the same time. You got a hint of that at the end of the quarter. Could be worse than that in the second quarter potentially. But if they all try to rush out at the same time, they're going to beat each other up trying to get out the door. And I think we got a hint of that into the end of March.
Antal, let me come back to you with this question. So I look at the pockets of the price where we have elevated volume, right? So let's say like supply is coming in here, demand is coming in here, and then I see cumulative here. So lots of demand. So far, whatever demand is coming in is producing the rallies, right? So this is great. And then I'm seeing that the supply signature is increasing. So the volume spikes are going up as the price goes down. Even here, in this reaction into that next sign of weakness, we see that supply is increasing. The next demand I see is coming in, obviously, again, on the way down, somewhere here and then here. So it's the same area, kind of like what we're seeing here as well, same area. And then demand is just non-reactive. So demand is diminishing a lot. It cannot rally like this. So this suggests still reaction, continuation down, lower low. Now, this is the next thing that is kind of shifting for me. And I'm trying to understand, is this the clarity of the timing for me, or is this the clarity of just like the read itself? Because what I'm seeing after the last demand that came in around this area right here, we are going down, but we're not going down like this. I mean, like looking at this type of spreads and thinking about like what's happening here, there is no intensity in the way of how selling goes down. It feels that supply is diminishing. We see that from the volume signature. And it's almost that demand is not so strong. So supply is capable of going down like this. At the same time, I'm looking at the gap right here. I'm looking at the next improved spread. If we were to take, let's say, like some comparisons of this and this. All right, so this looks way more attractive. Gap down, gap up, a better extension to the upside. And then right here, we're also seeing some improvements, both in how much more effort comes in and how much better result is. Here, same thing. Here, same thing. So again, this is the best. So I'm thinking like timing, or is it structure? Like, could we have another attempt to go down, retest, and then we go up? Or could we have something like of a structure and then slide down again and then go up? So how do you see this in terms of the supply, and how do you see this in terms of the improvement by the demand?
So the way I look at it, right? So we had a sign of weakness even here. Like once this area here, once we see this significant selling and the automatic rally, right? It's automatic reaction. It's a sign of weakness, right? Right here, because we kind of undercut the last climactic run, right? This rally here also, it's a sign of weakness. It's a lower high, and then look at the volume here, right? It's pretty muted, and then this is all weakness. For me, this area here, so inability to lift, right? We don't have any good rallies here. We have some attempts to stop the price, but that's pretty much it. This is ease of movement to the downside. There's no, this is our best rally. So yeah, I could see another retest on lower volume. We need to see an improvement, a significant improvement in demand, and like spreads and selling diminishing even more. Because this is still too aggressive, right? We're gapping here. We don't need a lot of volume, but like you said, if there is no demand, you don't need volume. The price just can, snowball.
Mm-hmm. All right.
That's how I will look at it.
Mm-hmm. Perfect.
All right. Tal, it reminds me of an old saying that prices can fall from their own weight, but they need volume in demand to put them up. So that's the thing. It's just like, it's just, what if the stock market gives a, opens up and nobody wants to buy it? There may not be anybody selling it, but, lack of demand is all it takes to put prices down.
Mm-hmm. All right. We've talked about gold. Bruce, all of the your P&F objectives that you have shown us, both on gold and silver, have been fulfilled. So a significant top, as Joe was talking about it, as Martin was talking about this, as we've been talking about this since the change of behavior bar on the daily chart, that we are going to be in the trading range. You know, it's still kind of like our call. It still stands out. I wonder, Antal, if you know, like your view is kind of the same, and I already know what it is, but still, could you give us our logic here with gold? What is your anticipation?
So we discussed this. We had this climactic move, right? I mean, we were discussing this area right here, and then also you don't have a volume on this bar, but that's a no demand bar right there. And then I think Martin was talking about this bar engulfing, right, which is a significant sign of weakness, right? It's an outside reversal after a no demand, after the signs like signs of supply, right? Significant supply coming in climax. So yeah, I would pretty much think the same. Probably in a trading range of sorts, like a big trading range. The same idea, right? Maybe a downslope, pretty much in this area, or yeah, but this is it's gonna be lengthy. It's gonna take some time. Because also, like you said, right, this is just too strong. This move up is too strong. So it's going to unwind, but it's going to take some time after this climax.
Mm-hmm. Okay. And Bruce, what a great study gold has been for WMD. I mean, we always anecdotally talk about our positions since 2019. We've talked about gold so many times on so many different occasions. We followed the whole campaign trail here, and I know that you've been heavily invested in gold-related, you know, assets for quite some time. What would you say from the campaign point of view? Let's say, like for me, I am campaigning gold since 2019, like you. Is there any reason to stay in this position?
Well, I do see the case for the range-bound condition for a period of time. As a matter of fact, you had, if you go back and look at 2011, you can see the buying climax, and you can see that there was about an 18-month period, well, maybe more like a year, where it just basically went sideways before continuing down. I could totally see something like that happening, and maybe it results in a reaccumulation. I don't know. There's, you know, certainly a lot of people that are looking at like devaluation of currencies and so on that see the case for this. But you know, I'm a pure Wyckofian, and so I would just say, you know, just first of all, as a campaign in August of 18, you can see that I noted that I wrote a blog and said at that support zone that was defined by the selling climax in 2013, that was an important low, a low risk low to be able to position gold. And that was an LPS completion of a pullback and created great symmetry. And look at the size of that structure. Now, keeping that in mind and seeing this back up over here to 2023-24 and thinking about it all the way over to 2011, that's a really big structure. Go back to that point and figure chart, Roman. Let's just keeping that vertical in mind. Yeah, so here, this count, you'll note that I have taken this count across here all the way back to 2011. And this is a 2% scaling point and figure chart method, and taking that count across that range gave us this count to 5449, call it rounding up, and it missed that high by 1 box, 1-2% box at the extreme. It threw over the top of that, and very, you know, typical, common. And so all that fuel potentially in that structure has been used up, and it resulted in a climactic acceleration into the count objective and a very sharp reversal back in. And I say take that as Wyckoffian point figure confirmation that that count is a good count. And I think the best case is that the market just goes sideways for some period of time as it builds cause for another move up or down. And so I think that our campaign was spectacular. We did it all in WMD. We talked about this over and over and over, and it worked out textbook. It's just it's a beautiful charts. Now looking at silver on the right, and you heard Martin's comments on silver, this is a point and figure count, traditional method, 2-point scaling going back from 2025 back to 2011. And there you can see that count, and look at how it went right into the middle of the count objective range at 120. Now, admittedly, it's a relatively wide count up there at that level, but it fulfilled the count at 120. And then look at the extent of the reaction off of that. That tells us that that count was valid and useful. And you know, I think Martin's conclusion on silver is that for the time being, that it's completed its upward move, completed it with a climax, fulfilled the point figure count objective with a climactic surge. And again, it's a beautiful chart. It's textbook. So I'm of the mind that yeah, gold and silver even potentially could hold their generally hold their value, especially against currencies for some period of time. But I think it's going to be a while before it becomes an opportunity again for appreciation. So that's the way I'm looking at it.
All right. Let's go to, well, we've talked about the gold miners, kind of touched upon this. Why don't we
just swing count there? We don't have to spend any time on it, Roman, but we've already rallied up to around 96, 97 even. You can see we're getting very close to the lower objective there. Now, that just may mean it needs to pause and build more cause, but that was a really nice little swing count, and it's up into that area, and it could go as high as 103. And so may have further to go, but anyway, a pretty dramatic bounce, and there's no signs it's done yet, but it you know, it should, if it is going to adhere to these counts, it should start to show compression as it's running up.
All right. We are close to the end of it. So with that, let's definitely look until at oil. You know, we've been doing all of this oil analysis for years and years, and it's been just fascinating to anticipate all of these moves. We've been absolutely all over the low here for a potential rally that's going to improve even over this. This came true. There's a very analogous news-driven rallies, just, you know, the amplitude is different. We've talked about this axis line right here that had first support, the break, the first test, more testing to the upside. So this was a very important area, not just to approach and look at the approach, how aggressive it is, but also to overcome. And did we overcome this? Yeah, definitely. And now the biggest question is obviously, you know, what's next after such volatility? Until you've mentioned several times in WTC2 classes that oil's volatility needs to deplete, needs to contract, diminish. At the same time, we still have some probabilities for continuation. We have some probabilities for, trading range development. How do you look at oil at this point? Are you expecting seeing, still more upside potentially, or some kind of trading range development here?
Like we were discussing this, right? So if this is a jump, it's pretty significant, right? The velocity of it and the way how the verticality of all this rally, right? Because of the war, and now we see some selling is coming in, but it's also diminishing, right? So yeah, I could see a retest of the highs here, right? Like we had in this area, and maybe a weak rally into this lower high and then another reaction. But yeah, as long as this war is going on, it's pretty hard to have
To kind of have like a clear picture here, a clear read. What about this comparison, like this rally back in 2022? And I mean, we have this space here. It's just that this bar, everything happens at once at this space, right? We could have like exactly this action right here into 1 or 2 or 3 bars. And that's a possibility. And then what Antal is talking about is just an attempt to go up, as kind of like a exhaustion of that demand. Bruce, obviously dependent on the news, anything can happen here, but I see that you have an extra count here for higher pricing in case of that rally that Antal talks about.
Yeah, I'm sort of the mind that we may have had this big jump on news about the outbreak of hostilities with Iran. And it did give us that initial count, which we have been looking at this accumulation for a period of time. And sure enough, that count went up and fulfilled at 118 and in our count objective zone. But more importantly, there's a bigger count. And Martin pointed out that there's a big demand out there unfolding for crude oil. And I'm wondering if when all the dust settles on the events in the Middle East, that we discover that this time you're completing accumulation and you're going into a new durable uptrend in crude oil, which could be a new campaign based on Martin's business cycle analysis. And that gives us the 145 and even higher. There's bigger counts after that.
I think this is such a great bridge, Bruce, to the next session next week as well. To talk about if indeed oil even stays at these levels, elevated, what does it mean? Because, as you and I, we've talked about in the prep session, there is plenty of oil. It's not that there is no oil that is discovered and not taken, from the ground. Plenty of that. But it's the adjustment to the new risk of unavailability of this as a resource, delivery, supply chain disruption. That's what's going on. So the market is repricing the risk associated with oil and gas delivery and availability. So it's like a little bit of a new regime type of thing. And Bruce, I really like your PNF here. And that's in line also with Antal's idea that, yeah, we could definitely rally here. Okay, well, what do you think, Bruce? We're at 541.
Wow, covered a lot of ground today.
Covered a lot of ground. Should we start saying thank yous to everyone and just basically?
I want to get to the cake.
Oh, the cake, yeah, for sure.
Yeah.
Oh, one more thing. This is pretty interesting, and I've been shown in WTC2 this data as well. I wonder what you think. So looking at those big bars, right? Those candy bars, and the latest right here. Look at the Wyckoff communal watch list that we have. And on day by day, February 6th, remember that technique that I always talk about? Look at the breadth of the market. 47 names on this day right here. And this is off the top, so you still have a pretty strong demand coming in. 47 names in our Wyckoff communal watch list went up 5% for that day. Going down and now having this day very similar in size and spread, but definitely less efficient. Only 18 names, still pretty high, right, as a number. Going further down, and we said that there was an improvement in spread right here and also in the amount of volume that came in. So it was improving demand, it was moving easier. 23, so a slight increase, +5, but still an increase. And then yesterday, on this big day, you could see this in the numbers from 23 to 65, almost ×3. And I want to point your attention also to the double digits, right? It's not just ×2, but ×3, 15%, 16%. So whatever we had yesterday definitely has some legs to extend, and the follow through, as we saw, was better than this, and this, and this, as Antal was pointing out. So pretty interesting numbers, Antal, in terms of how these specific bars that have the same characteristics are showing different breadth characteristics.
So that kind of tells us that we might have a better rally, right? We might have the best rally on this reaction to the downside, this whole move to the downside. So it could be a change of behavior rally. Let's see how it's gonna develop, right? If we get back in the structure, and then what's gonna be the test of it, because it's gonna get tested, right? This change of behavior, even if it's a rally or it's gonna be just a few bars, it's still gonna get tested eventually. So if the test holds, we might have a change of behavior. We might get back in the trading range and maybe retest the highs.
Bruce, pretty significant number of 5% plus 65, yesterday. So it's kind of interesting how through the communal Wyckoff watch list we could see the breadth changes.
Yeah, and this is a reflection of the end of the quarter, where there was a buyer strike at the in the quarter, and there was a lot of selling, really motivated selling by window dressing. And now that that's all behind us, it just opens the way for a much better rally phase ahead. And I do think that this could be a very good rally, even though it may be an LPSY, but it could go on for a period of weeks. And the other thing is I think that this data, which is very interesting, just supports the green shoots of the advanced decline oscillator that we showed earlier, and that it's walking uphill. So there was a lot of good stocks that were already walking uphill even before the quarter ended. And so this is, we're going to get a good rally, I think.
All right. Well, with that, Bruce, did you want to touch on this?
Yeah, we'll talk about it next week.
Next week. Okay. Yeah, let's build the bridge to the next week, guys. This is something that we do each week. You're talking about the market from different perspectives. Antal, thank you so much. Really appreciate the way of how you view the market, your availability. Really grateful to Alessio being able to come, and I know it's really late for him. The team behind us, Nancy and Owen, supporting the whole event. There has been a lot of preparation sessions. Wonderful guests, Joe and Martin, just such an amazing talent, experience combined together, visibility, clarity of the chart. And Antal, as I was watching Martin to go through the chart, one thing for me personally, it's like, wow, we're looking every day on the intraday, like some short-term swings. He is looking at like decades of data, and when you follow his thoughts, the perspective changes. There is definitely a lot of stuff there that we have not talked about or we have not seen. So it just has been so amazing to have both of them and discuss it with Bruce. Bruce.
Joe has a concluding comment.
Okay, Joe, please.
Actually, two observations quickly, if I could. One, you brought, when you were discussing Tesla, I do think, and you brought up two non-Wyckofian terms about a possible breakout. And Roman, you talked about robots might be, something that could goose the stock. And Bruce brought up Martin's interpretation or evaluation rather of energy and the fact that gasoline may go high or stay high, and that would give a boost to EV sales. But you guys missed the real important point, and that is when SpaceX goes public next month or so, we're going to have the world's first trillionaire, and everybody's going to want to be a part of that one historical event, and they're going to buy at least a share of Tesla each. So there's that. But the other thing I wanted to say is, as you gave out thanks there, Roman and Bruce, the fact is of doing 500, versions where you guys have put the effort in, the time, but also the knowledge and experiences and wisdom that you pass on to everybody to benefit. I think that's the part that's really should be celebrated. And your team, so to the two of you, your team, including Nancy, and also all the people that listen in, that in fact are making that effort to learn, to grow, to be better decision makers. I congratulate all of you too. So I just want to say, truly congratulations for 500 issues. And as a result of what you do, you grow new talent like Antal. So thank you for all that you guys do.
Joe, well received, appreciated, and again, thank you for your presence here. Because Bruce, I feel like we are just a bunch of friends that are discussing the markets. Like every class to me, whether I'm discussing the markets with you, with Antal, or anyone else, it's kind of like that. It's the exploration, and it's not just the technical exploration, but obviously exploration of self. And I always keep mentioning this. Behind all of the technical development that the company does on trading, there is something very meaningful that has been around for 15 years now within the company. People come, they connect to each other, and connection stays. And Bruce, this is just so wonderful. And this 500 episodes is just one of the elements of that idea. To connect, stay connected, to go through something together. And it's been a blast for me personally to have that journey with all of you, and especially with you, Bruce. So thank you.
Thank you. And thanks for coming up with this great idea to do this 10 years ago. So who knew? Who knew?
Are you up to for the next 500 episodes?
I'm
I'm
already
giving you the way out right now. Like if you're gonna say that's it, I'm done, I will totally accept this and understand. But if you say we go, I go with you.
I'm already building the slide deck
For the next 500 episodes. Okay. Well, I guess we don't have a choice. With that, guys, we are waiting for you next week. With a lot of new ideas, continuation of what we've been developing. enormous thank you to all of you. It's because of you the team is so solid and strong. And I'm just as much as proud of the community that surrounded us, that, you know, like that attraction of like-minded people. It's an amazing thing. It's a very powerful thing. So with that, not only we have this super team, but we have just super community, Bruce.
Absolutely. I'm grateful for you all, and especially you, Roman. Thank you.
Well, absolutely appreciate everybody. And Bruce, with that, I will see you next week. Antal, Alessio, Joe, Martin, what a wonderful, you know, additions to our celebration. Thank you for being with us. Thank you, the team members, and thank you, all of you guys. Thank you. And until next week,
Thank you all.
501 episode, Bruce.
Have a great week, everybody.
Thank you. Bye-bye.